Hello everyone, welcome to my channel. Today I'm going to talk about bookkeeping mistakes that trigger IRS audits. Nobody wants to receive a letter from the IRS asking questions about their tax return. For business owners, the thought of an audit can be especially stressful because financial records, expenses, deduction, and business transactions may all come under scrutiny. While there is no bookkeeping mistake that automatically means you will be audited, inaccurate or inconsistent financial records can increase the chances of problems during tax filing or mistake an IRS examination much more difficult. The good news is that many bookkeeping mistakes are completely avoidable. In this video, I'm going to look at some of the most common bookkeeping mistakes business owners should watch out for and how better bookkeeping can help keep your financial records accurate and defensible. The first thing is mixing business and personal expenses. One of the most common bookkeeping problems is using business accounts to pay for personal expenses. Maybe you use the company credit card to buy groceries, pay bills, pay personal bills, or purchase something for the family. If those transactions are recorded as business expenses, your books may show deductions that ain't actually business expenses. This creates unnecessary risks. The solution is simple. Keep business and personal finances separate whenever possible. Use dedicated business bank accounts and credit cards and properly categorize transactions that's in business related. Clean separation makes your financial records easier to understand and helps your tax professional determine which expenses may legitimately qualify as business deductions. The second thing is claiming unusually large expenses. Business expenses naturally vary from company to company. However, unusually large deductions compared with the business income or odd industry can attract additional attention. For example, imagine a business reporting relatively modest revenue while claiming extremely large expenses year after year. That does not automatically mean anything is wrong, but significantly discrepancies can raise questions about whether the expenses are legitimate and properly documented. The lesson isn't to avoid legitimate deductions, it's to make sure your deductions accurately reflect your business activity and that you have documentation to support them. The third thing is failing to keep receipts and documentation. One of the biggest bookkeeping mistakes is recording an expense without keeping supporting documentation. A transaction in your accounting software may tell you that you spent $500, but it does not necessarily explain what you purchased, why you purchased it, or whether it was a legitimate business expense. Keep receipts, invoices, contracts, mileage records, and other relevant documentation according to applicable recording requirements. Good documentation gives you a much stronger financial paper trail if you ever need to explain a transaction. The fourth thing is misclassifying expenses. Another common problem is putting expenses into the wrong categories. For example, a business owner might classify personal spending as advertising, record equipment as ordinary expense, or categorize a loan payment entirely as an expense when part of the payment may represent principal. These errors can affect your financial statement and potentially your tax return. Regular bookkeeping reviews can help identify incorrect classifications before tax season arrives. If you're unsure how a particular transaction should be treated, ask your bookkeeper or tax professional instead of guessing. The fifth thing is reporting income incorrectly. Expense ain't the only issue. Business owners also need accurate records of income. Failing to record all business revenue, recording income twice, or reporting numbers that do not match other financial documents can create inconsistencies. For example, your bookkeeping records should generally make sense when compared with your bank deposits. Payments processor reports, invoices, and other relevant records. Reconciling these accounts regularly can help identify discrepancies before they become larger problems. The sixth thing is ignoring cash transactions. Cash businesses can face additional bookkeeping challenges. If your business receives cash payment, every transaction still needs to be properly tracked and recorded. Failing to maintain accurate cash records can make your reported revenue difficult to verify. Whether customers pay by cash, check, credit card, or bank transfer, or an online payment platform, your bookkeeping system should provide a complete picture of business income. The seventh thing is not reconciling your accounts. Imagine looking at your accounting software and assuming the balance is correct without comparing it to your actual bank or credit card statements. You could have duplicate transactions, missing expenses, incorrect deposits, or other errors hiding in your books. That's why account reconciliation is so important. Reconciling your accounts regularly helps confirm that the transactions recorded in your books match the activity reported by your financial institution. It can also uncover mistakes early when they are much easier to fix. The eighth thing is waiting until tax season to do your books. Perhaps the biggest mistake is treating bookkeeping as a once a year task. Trying to reconstruct 12 months of financial activity right before filing taxes creates unnecessary stress and increases the possibility of missing information. Instead, update your books regularly. Monthly bookkeeping allows you to identify problems while the transactions are still fresh in your memory. It also gives you a clearer picture of what your business throughout the year. In conclusion, I believe an IRS audit isn't something you can completely prevent, and being audited does not necessarily mean you have done anything wrong. However, accurate bookkeeping can make your financial life much easier. Keep business and personal expenses separate. Record all income, Categorize expenses correctly. Reconcile your accounts. Save supporting documents. And keep your books up to date throughout the year. Most importantly, do not create deductions simply because you want to lower your tax bill. Your goal should be accurate reporting and legitimate tax deduction supported by proper records. Good bookkeeping isn't just about knowing how much money your business made. It's about creating a reliable financial record that helps you, your accountant, and your tax professional understand exactly what happened financially during the year. If you take the time to maintain accurate books now, you will be in a much better position if tax season or an IRS letter even comes your way. Remember, IRS audit selection can depend on many factors, and no particular bookkeeping mistake guarantees an audit. For questions about your specific tax situation, always consult a qualified tax professional. Thanks for watching this video, and do not forget to subscribe to my channel.